Oil prices have plunged recently. They're down more than 50%, and that's got people nervous. It's got investors nervous. It's one of the reasons the stock market has been down lately. So a research firm, Oxford Economics, decided to take a look at this. They said, let's do a report that tells investors everything they need to know about low oil prices. They named it Oilopedia. And what they found is that when you look around the world, when you look around the economies of the world, the haves and the have-nots of cheap oil are not split down the middle. There are a lot of countries that do better with lower oil prices and only a few that do worse. The U.S. is kind of in the middle of the pack of the countries that do better. The problem is for the countries that do worse, Russia, Saudi Arabia, Norway, they do a lot worse when oil prices are low. And the same is true for the U.S. market. Lots of people, especially consumers, will do a little better when oil prices are low. But there are a few large companies like oil giant ExxonMobil and the oil and gas drillers that will do worse, a lot worse. So it's easy for investors to sell those companies first and think about who may gain later. But the big takeaway is this: lower oil prices are generally good things. They're good for the economy, they're good for markets, they're good for investors, as long as you stay away from the places that'll do a lot worse.